Welcome to the exciting world of equity securities. These financial instruments are vital for investors of all levels. When you own equity securities, you're not just holding paper, you're holding a piece of a business. This ownership comes with the potential for significant rewards. As companies grow and prosper, so too can the value of your investments. Imagine owning a tiny slice of a tech startup that becomes the next Apple, or a small stake in a coffee shop that expands into a global brand. But this potential for high returns doesn't come without risks. Like a roller coaster, equity markets can be thrilling and unpredictable. Prices can fluctuate, sometimes dramatically, and there's always the possibility that a company's fortunes could take a downturn. Navigating those risks and reaping the rewards is what we'll explore throughout this comprehensive guide. Every investment comes with a degree of risk, and equity securities are no exception. The stock market can be volatile, with prices swinging based on various factors. One significant risk is the potential for loss of principal. Diversification is crucial to mitigate risks. When you purchase equity securities, you're not just buying a piece of paper, you're gaining a voice in the company's future. Shareholders are part owners, and with ownership comes certain rights and privileges. One of the most significant shareholder rights is the power to vote on key corporate matters. This includes electing the board of directors who oversee the company's management and weighing in on major decisions like mergers, acquisitions, or changes to the company's bylaws. Beyond voting, shareholders also have the right to receive information about the company's financial performance and business operations. Companies are required to provide shareholders with regular financial reports, including annual reports and quarterly earnings statements. These reports offer insights into the company's revenue, expenses, profits, and overall financial health, allowing shareholders to make informed decisions about their investments. Investing in equity securities offers the enticing potential for growth, but it also opens the door to another attractive perk: dividends. Think of dividends as a way for companies to share their profits directly with their shareholders. When a company performs well and generates earnings, it can choose to distribute a portion of those earnings back to investors in the form of dividends. These payouts can provide a steady stream of income for investors, supplementing other sources of income or being reinvested to purchase additional shares. Not all companies pay dividends. Some choose to reinvest all their earnings back into the business to fuel further growth, while others may not yet be profitable enough to distribute dividends. For investors seeking income, dividend-paying stocks can be an attractive option. However, it's essential to remember that dividend payments are not guaranteed. One of the most significant advantages of investing in equity securities is the protection of limited liability. This fundamental principle shields shareholders from personal responsibility for the company's debts and obligations. In simpler terms, if the company you've invested in faces financial troubles or legal challenges, your personal assets are protected. Creditors can't come after your home, car, or other personal belongings to satisfy the company's debts. This protection stems from the fact that a corporation is considered a separate legal entity from its shareholders. Limited liability encourages investment by reducing the potential downside for shareholders. It allows individuals to invest in companies with the peace of mind that their personal assets are shielded from business risks. In the world of equity securities, there are various ways to hold and manage your investments. One of the traditional methods is through physical certificates. Imagine receiving an elegant paper document, often adorned with intricate designs and official seals, certifying your ownership of a company's shares. These certificates typically display key information, including your name as the shareholder, the number of shares you own, and the company's official seal. For many investors, especially those new to the world of finance, holding a physical certificate evokes a sense of ownership and connection to their investments. However, physical certificates come with certain drawbacks in today's digital age. They can be lost, stolen, or damaged, creating a logistical headache for investors. As the financial markets evolved, a more streamlined method of holding equity securities emerged: street name registration. This approach simplifies investment management by allowing investors to hold their securities in electronic form through their brokerage accounts. When you purchase shares through a brokerage account, the securities are typically registered in the brokerage firm's name, not yours, on the company's books. While the brokerage firm holds the securities in its name, you retain all the rights and benefits of ownership, including voting rights and dividend payments. Street name registration offers several advantages over physical certificates. You don't have to worry about losing or damaging physical certificates, as your securities are held electronically by your brokerage firm. Buying and selling shares is as easy as a few clicks on your brokerage account, eliminating the need to physically deliver certificates. Street name registration has become the standard practice for most investors, offering a secure, convenient, and efficient way to manage equity investments. For investors seeking greater control over their investments and a more direct relationship with the companies they invest in, direct registration offers a compelling alternative. Unlike street name registration, where securities are held in the brokerage firm's name, direct registration allows you to register your shares directly in your name on the company's books. This method provides several distinct advantages. First, it fosters a closer connection between you and the company. You'll receive company communications, including annual reports, proxy statements, and dividend checks directly from the company, eliminating any delays or intermediaries. Second, it enhances security and reduces the risk of fraud. Since your shares are registered in your name, it's more difficult for unauthorized individuals to make transactions or gain access to your investments. Direct registration appeals to investors who prioritize direct communication, enhanced security, and simplified estate planning. In the world of equity investments, understanding a company's financial performance is paramount. One of the most widely used metrics to gauge a company's profitability is earnings per share, or EPS. Think of EPS as the portion of a company's profit that is allocated to each outstanding share of common stock. Calculating EPS is relatively straightforward. You take the company's net income, subtract any preferred dividends, and then divide the result by the number of outstanding shares. For example, if a company has a net income of $10 million, pays $1 million in preferred dividends, and has 1 million outstanding shares, its EPS would be $9. Investors and analysts closely scrutinize EPS, as it provides valuable insights into a company's profitability and its potential for future growth. Understanding EPS is fundamental for investors looking to assess a company's financial health and make informed investment decisions. When analyzing a company's financial health, it's crucial to look beyond simple metrics like EPS and delve into the complexities of its capital structure. A company's capital structure refers to the mix of debt and equity financing it uses to fund its operations and growth. Companies can raise capital through various means, such as issuing common stock, preferred stock, bonds, or taking on loans. The specific combination of these financing sources constitutes the company's capital structure. Understanding a company's capital structure is essential for investors because it provides insights into its financial risk and potential for growth. Companies with a high proportion of debt financing are considered more leveraged. While leverage can amplify returns, it also increases financial risk. Analyzing a company's capital structure requires careful consideration of its industry, growth prospects, and overall financial health. Dividends reward shareholders and signal confidence in future prospects. Companies distribute profits as dividends, providing a steady income stream. Dividends can be cash or additional shares. The board of directors decides on dividend payouts. Mature companies often pay larger dividends. Growth companies reinvest earnings for expansion. The world of equity securities is incredibly diverse, offering a wide array of investment options. Investors can choose from a variety of equity types to align with their strategies. Defensive stocks provide stability during economic downturns. Companies in essential sectors like consumer staples and healthcare weather economic storms better. Cyclical stocks are tied to the economic cycle with amplified growth during booms. Market capitalization, sizing up investment opportunities. Market capitalization guides investors toward companies of different sizes and growth trajectories. It represents the total market value of a company's outstanding shares. Categorize companies from nimble startups to established giants. Micro-cap stocks have the smallest market capitalizations, under $300 million. These early-stage companies offer high potential returns but significant risk. Their stock prices can be volatile and future prospects uncertain. As companies mature, they transition into the small cap category, ranging from $300 million to $2 billion. Section 3. Beyond common stock, exploring other equity instruments. While common stock reigns supreme in the realm of equity securities, a diverse array of other equity instruments awaits the discerning investor. These instruments, each with its unique characteristics and risk-return profiles, offer alternative avenues to participate in a company's growth and profitability. One such instrument is preferred stock, a hybrid security that blends features of both equity and debt. Like bonds, preferred stocks typically pay a fixed dividend, providing investors with a steady stream of income. However, unlike bonds, preferred stockholders have an ownership stake in the company, albeit with limited or no voting rights. Another intriguing option is convertible securities, which encompass convertible bonds and convertible preferred stock. These hybrid instruments offer investors the best of both worlds, the steady income stream of a bond or preferred stock, with the potential to convert into common stock at a predetermined price. Expanding your investment horizons beyond domestic borders can unlock a world of opportunities in the global equity market. International equities, representing ownership in companies domiciled outside your home country, offer access to new markets, industries, and growth stories. Investing in international equities can enhance portfolio diversification, reduce overall risk, and potentially boost returns. However, navigating the complexities of investing in foreign companies can be daunting. Currency fluctuations, geopolitical risks, and varying accounting standards add layers of complexity to international investing. Fortunately, American Depository Receipts, or ADRs, provide a convenient and accessible way for US investors to gain exposure to foreign companies. ADRs are US dollar-denominated securities that represent ownership in the shares of foreign companies traded on US stock exchanges. They simplify international investing by eliminating the need for investors to deal with foreign currency transactions, custody issues, and unfamiliar regulatory environments. Imagine a bustling marketplace where buyers and sellers converge, eager to trade. The secondary market is this vibrant hub, facilitating the buying and selling of shares. Unlike the primary market, where companies first issue shares, the secondary market is where the real action unfolds. Liquidity is the lifeblood, allowing quick and efficient portfolio adjustments. Think of it as a well-oiled machine, ensuring smooth transactions and efficient price discovery. Exchanges like the NYSE and Nasdaq provide platforms for listing and trading securities. Market indexes serve as lighthouses, guiding investors and providing benchmarks to assess market performance. These indexes track the performance of a basket of stocks representing a particular market segment or the overall market. The Dow Jones Industrial Average, established in 1896, tracks 30 large publicly owned companies. The S&P 500 encompasses a broader representation, tracking 500 large cap companies. Investors monitor indexes to gauge market sentiment and compare portfolio performance. As we conclude our exploration of equity securities, knowledge is your most valuable asset. Grasping the fundamental concepts we've covered is crucial. Equity securities offer potential for growth and income. However, they come with inherent risks like market volatility. Diversification, thorough research, and a long-term perspective are key. Focus on building a diversified portfolio of quality companies. Remember, investing is a marathon, not a sprint. Stay informed and continuously educate yourself. You'll be well equipped to navigate the dynamic world of equity investing.